Hello everyone. Well, rising interest rates were again the main theme overnight as 10-year treasuries hit 2.88% and expectations for Fed funds rose almost back to the July peaks. Emerging market currencies were crushed, with the beleaguered Indian rupee falling 3.5% against the dollar, even though it was already at a record low, and the Indonesian rupiah down 2%. The Mexican peso and South African rand were both down by more than 1%. The market is questioning how these countries with current account deficits will be able to fund themselves when money is less abundant and U.S. interest rates are more attractive. By contrast, the dollar was mixed against the G10 currencies, with the Swiss franc, the euro, and the pound gaining modestly against the U.S. currency. Now, it's my view that over time, the yen is going to be used as the funding currency of choice. The country has a widening trade deficit, as we saw yesterday, and is the one currency where there's no risk at all of the central bank closing off the money spigot anytime soon. Just as importantly, the Bank of Japan has so far been successful in keeping nominal interest rates down while raising inflation expectations. In other words, lowering real yields. As the U.S. starts to taper off its quantitative easing, Japan should become the major source of liquidity within the G10, in my view, and I'd expect to see yen carry trades come back in force. That suggests a higher dollar-yen. Sterling is also likely to be under pressure as the focus moves to current account deficits. The Swiss franc, by contrast, would be likely to hold up relatively well on that account. Now, overnight, the minutes from the recent Reserve Bank of Australia meeting showed that another cut in rates isn't imminent, but that, quote, the course of the exchange rate would be important, unquote, in setting policy. That implies that the RBA will be likely to cut interest rates if the Australian dollar rises. Aussie dollar fell as a result. I expect that the Australian dollar will continue to weaken as the interest rate support disappears and the terms of trade move against the currency. There are no major European indicators out today. In the US, the Chicago Fed National Activity Index is expected to improve slightly, but this is unlikely to be a major market moving event. As a result, I expect another fairly quiet day among the G10 currencies, but with emerging market currencies likely to remain volatile. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.